The largest bank. I sat down with JPMorgan Chase Chairman and CEO Jamie Dimon here in San Francisco yesterday, getting his perspective on everything from market volatility to China trade and the economic impact of tax cuts. I started by asking him about his concerns of a possible slowdown in economic growth in the next 2 years.
Yeah, so I think you had kind of the narrative in October that things were doing very well, global synchronized growth. IMF said it may be one of the best years ever. All of a sudden, you got some data from Germany, Japan, and maybe a little bit of slowdown in the United States. But it looks to me like a slowdown. Sentiment changed dramatically. It changed for a whole bunch of different reasons. But the globe is still growing. The United States is still growing 2.5%. We just had some good wage data. So it's very possible you have a slowdown, a big shift in sentiment. Maybe people take a deep breath and things will open up a little bit.
But, I mean, when you look at all asset classes having declined, you know, whether it's stocks, you know, bonds, you've got energy, and even as the Federal Reserve is raising interest rates, you've got the 10-year going lower, and then you have the inversion of the 2 and the 5-year. Yeah. Do these things not worry you?
Not a lot, because I think that sometimes you sort of asset price, I'm doing stocks, but I'd say the same thing for other asset prices too. You know, the world, if stocks in America are at 18.5 times PE, and now they're at 16. Sometimes there's a good reason for that. Slower growth is a good reason. People do have concerns about rising rates. They do have concerns about trade. I think trade has caused a lot of volatility in the marketplace. So sometimes that adjustment is reasonable. And prices now are more reasonable. And, you know, like with high yield, we had no bond issuance in December. My guess is you'll see something happen soon. And the markets kind of open up if they take a deep breath. And it looks like there will be growth. It's not like we're going to a global recession. We're going to have slower growth than maybe people expected a couple of months ago.
I'm glad you mentioned that, because there was no high-yield debt issuance in the month of December, and it's the first time that's happened in a decade.
Yeah,
is that an ominous sign? I remember during the financial crisis, which you lived through and you led with such great leadership, it was the debt markets that got us into trouble.
Yeah, but it was the deleveraging, the liquidation of debt markets, not the lack of issuance. So my view is that in December things slowed down, people got scared, issuers didn't want to issue, spreads gapped out. That'll probably change.
How long can the credit market stay this tight before you actually do see it as a worry sign?
For a while. I'm really not worried about it. I think you're just having, if you look at the other way around, credit spreads were abnormally low for a long time. This is more, maybe a little bit of a normalization. And, you know, you and I both know that the tip of the iceberg, the tip of the spear is IPOs and high yield. So when sentiment changes dramatically, those are usually the first two areas where people cut back. And then they kind of open up over time.
Yeah, it's interesting you mentioned that, because it's a big IPO calendar that we're looking at for 19. What kind of a year are you expecting?
I think it'll probably be okay. I think you're going to see some IPOs done, and I think once those markets open up, you'll see people issue.
Tell us about the credit card business and what you're seeing there, because the fundamentals seem to be okay, putting the market volatility aside. But you've got a great vantage point in seeing how consumers are doing from your credit card business. What are you seeing?
So credit card, I mean, it's very good. I mean, again, if you look at actual data, people getting jobs, more people working, wages going up, wages are going up. Household balance sheet in very good shape, credit card credit, extraordinarily good. I think it's better than we deserve at this point in the cycle. And if you look at actual spend, you know, if you look at retail spend, home improvement spend, a whole bunch of it, it's pretty good. And so, you know, my view is that the consumer's in good shape and is continuing to grow, and they have backwind with jobs and wages going up.
There was some worry about the auto business. You still seeing that in terms of auto loans?
Not really. Again, we went from, I think it was 10 million of auto sales in the bottom of 09 up to 17. We've been at 17 for a couple of years. It's slowed down a little bit. It's still around 17 or just under 17. That's a lot of car sales. On the auto loan side, I think you've seen subprime isn't very big. It wasn't a problem in 09. It isn't a lot bigger today. You know, you may have someone have an issue in subprime credit, but no, we see it being okay.
You were pretty positive on the tax cut plan, right,
yeah,
when this was first enacted. Has that been one of the big positives in terms of creating some stimulus for this economy? What's your take in terms of how we got here?
Yeah. So I think the tax plan, this is really important for the American public to understand. You need a competitive business system. You need it permanently to compete in the globe. And so we, at America, 40 years ago, 20 years ago, we had 40% federal and state. The world's at 40%. They came down to 25%. We stayed at 40. The result of that was cumulative, okay, that over time, companies and capital ended up moving overseas, and people and research, and it was a huge mistake. So my view is it should be competitive. It also provides stimulus in the short run. some companies, I know people complain about stock buybacks, but some people raise wages, open plants, did acquisitions, all good things. And the other thing about stock buybacks, which I just find so confusing, is if a company can't use the capital they have, and they buy back stock or increase dividends, that's simply recirculating capital. It goes to a higher and better use. And the people shouldn't complain about that. We don't always know what that use is going to be, but that's a good thing. They're not retaining capital they don't think they need.
It's more activity.
It's more activity.
And you want to see that. Right. So what are your thoughts on what we're hearing now from, for example, Alexandria Ocasio-Cortez? She says she thinks that the top end of earners should pay as high as 70, 80% tax rates.
Yes. Look, I always separate the corporate side, the business side, which I think we need to be competitive with the individual side. And so, people have all different theories about the individual side and what maximizes returns and stuff like that. So I don't get involved in that debate because I'll leave that to the politicians. That is actually less important for economic growth than the business side.
Yeah, the top 10% already pay 80% of all the tax.
They do. But in America, you have to look at taxes broadly. I mean, a lot of payroll tax are regressive, sales tax are regressive, real estate tax are regressive. So you look at the big picture, anyone can say, we should relook at this and make it better and more efficient and fairer.
Are you saying you wouldn't mind to see the top end pay 80% in taxes?
No.
You wouldn't mind that?
No, I'm not saying that.
Oh, okay. Just to be clear. Okay. Yeah. Because that would be double where we are right now. Yeah. Almost double, certainly.